Welcome back to another Georgia Department of Community Affairs Office of Portfolio Management training. This training is going to be a review of what's changed from our DCA LIHTC and Home Compliance Manual. Our last iteration was published in 2023. If you look at the cover page of any of our compliance manuals, just at the bottom there, you will find the edition in which you are referencing. This one was published March 2023. The new iteration was published just 1 year later in March 2024 and includes new policies and regulatory updates, mainly HOTMA and NSPIRE, as well as some minor clerical or clarifying changes. So do make sure that you're referencing the correct compliance manual because we are currently adhering to the 2024 edition. So the very first change that you'll see in the compliance manual is the information that was added to the very first page. It's highlighted here in green and reads, "For up-to-date information regarding our programs, such as training, fees, deadlines, policies, etc., please visit our website at www.dca.ga.gov regularly." We want to emphasize the word here, regularly, because we are making a concerted effort to ensure that our website is current and up to date. So please do visit our website for the most recent and most up-to-date information. So our next change comes with the addition of the National Standards for the Physical Inspection of Real Estate, or better known as NSPIRE. Physical inspections were previously referred to as physical inspections and UPCS, referring to Uniform Physical Condition Standards Protocol. The current language under the Compliance Monitoring and Inspections states physical inspections and NSPIRE, noting the change in inspection protocol from UPCS to NSPIRE. There is also the addition of findings and cures. All of this information can be found and begins on Chapter 1 in page 44. We'll take a look a little bit further into what these changes mean. So under physical inspections in UPCS, the old inspection protocol, UPCS identified inspectable areas as site, building exterior, building systems, common areas, units, and health and safety. Both UPCS and NSPIRE still collect monitoring fees that are applied for each individual unit that has passed the 15-year compliance period. UPCS and now NSPIRE both follow a standard, and that standard followed the HUD-REAC standard minus the scoring. That is for LIHTC and home projects. Now, as we transition to NSPIRE, the inspectable areas have changed. The inspectable areas under NSPIRE are now the outside, inside, units, and the focus is now on health and safety. In addition, under NSPIRE, findings and cures must be submitted timely and uploaded to Emphasis and must follow the guidelines. The NSPIRE guidelines can be found in the compliance manual. Please make sure that you reference the compliance manual for the standards that you should be following for your project type. Lastly, local codes, accessibility protocol, and extension request have remained the same. We have many properties in our portfolio that involve the Public Housing Authority, or PHAs. In some circumstances, the PHA is charged with verifying income. So previously, PHA verification of income was not acceptable for home move-ins where source documentation were required. But now, PHA verification of income is actually required for households in home units. This change in policy begins in Chapter 4 on page 111. So let's take a deeper look and see what this policy change actually means. When it comes to the PHA, there are ways to verify income for LIHTC and home projects when individual households receive housing choice voucher assistance provided by a local public housing authority. Let me back it up for a moment. A housing choice voucher, or HCV, is a form of tenant-based Section 8 rental assistance provided by a local public housing authority, or PHA, to individual households. If documentation is received by an owner agent from the PHA stating the household's income and composition, then that documentation is considered third-party verification. HUD 50058 certification form may be used as verification of income for LIHTC income certification. If it is not possible to obtain the 50058 from the PHA, then a signed statement from the PHA indicating the household's gross annual income may also be used to verify income. So previously, PHA verification of income was not acceptable for home move-ins where source documentation was required. It was, however, acceptable for home recertification only on years that did not require source documentation. While it is an option for LIHTC purposes, the provision to accept PHA verification of income is now required for households in home units that hold housing choice vouchers with the PHA at move-in and recertification. The basic process for verification is the same as the LIHTC program. That is, the gross income that is used for home purposes before any adjustments that the PHA may make before the rent is calculated. Also, note the 50058 certification form only serves as verification of income. Other paperwork, such as an application, student status paperwork, and a TIC must also still be included in the file. So FYI for home projects. If a property has only a portion of the unit's tax credit home and the remainder are just tax credit, are assets verifications required for all units or just the units identified as home in the 6th year? The answer to this question is just the home units would require source documentation. Also, what form do we use for properties that are not 100% tax credit? And the answer to that question is you would use the asset certification if combined net assets are less than the threshold. Otherwise, third-party verification of the assets is necessary. With the provision of HOTMA came several updates to existing regulations. However, in some cases, new rules were created altogether to expand existing rules. Safe harbor is a new rule that did not exist prior to the HOTMA update. In this case, HOTMA expands public housing authority verification rules. This new rule is detailed in Chapter 4, beginning on page 112. We've already talked about the ways in which income can be verified for households receiving assistance from a public housing authority or PHA. HOTMA, though, expands the PHA verification rules into a bigger allowance, although this does not apply to home units. It allows owners, agents to use income determinations from not just PHAs, but several other means-tested programs. The income determination of the program must have occurred in the last 12 months from receipt by the owner agent. These programs determine eligibility using income limits and have their own rules to determine income. They do not have to use HUD rules to be acceptable for HUD purposes. HUD refers to this verification process as safe harbor. The allowed programs under the Safe Harbor rule are the Temporary Assistance for Needy Families, or TANF, Medicaid, the Supplemental Nutrition Assistance Program, or SNAP, the Earned Income Tax Credit, or EITC, the Low Income Housing Credit, or LIHTC, or LIHTC, the Special Supplemental Nutrition Program for Women, Infants, and Children, or WIC, as well as the Supplemental Security Income, or SSI. Also allowed are other programs administered by HUD and other means-tested forms of federal public assistance for which HUD has established a memorandum of understanding. Moving on, the following changes are related to income and assets: how to calculate income, what counts as income, how to calculate assets, and specific asset types. This information can be found in chapters 4, 5, and 6, respectively. So what's changed? Starting with the cash value of assets, we will look at changes to the cash value threshold for assets. Next, we will look at the income inclusions and exclusions, as well as new income category related to periodic and sporadic income. Hint, there are new exclusions. And there have been some pretty significant changes made to student assistance, which we will also look into. And then lastly, we will look at the addition to specific asset types. Starting with the cash value of assets, let's look at the changes to the cash value threshold for assets. When it comes to the verification of assets and imputing asset income under the LIHTC, Home, HUD, and NHTF programs, the threshold for the cash value of households' assets has increased to $50,000 as adjusted. This policy update can be found in Chapter 4, beginning on page 113 of the new DCA LIHTC and Home Compliance Manual. Before, when the cash value of a household's assets was $5,000 or less, third-party verification of assets was not required, and self-certification was allowed. The household was required to complete a certification of assets affidavit indicating that household assets did not exceed $5,000. The HOTMA update of 2024 states now when the cash value of a household's assets is $50,000 as adjusted or less, third-party verification of assets is not required, and self-certification is still allowed. The update also now states that the household is required to complete a certification of assets affidavit indicating that the household assets do not exceed $50,000. Remember, income eligibility is a crucial factor in certifying a household for one of our housing programs. The following methods of verification are preferred by DCA GHFA in this order. DCA prefers third-party verification documents primarily, and self-certification when third-party verification sources are not possible. When accepting third-party verification documents that are prepared by third parties and supplied by the household, earned income is the highest preferred documentation. That is, verification of employment, military pay, or information obtained by Equifax's work number. Unearned income, such as pension, Social Security, unemployment, child support and alimony, and benefit payments, are next. Assets, and lastly, student status. Self-certification is still allowed under the HOTMA changes other than every 6th year of a home project's affordability period. We're going to take a closer look at assets in just a moment as there have been changes. But first, let's delve into some additional changes regarding income calculations. For most household members, all earned, unearned, and asset income is counted as income. Annual income, as defined by HUD, is the amount of income that is used to determine a household's eligibility for federal LIHTC and DCA GHFA home funds housing. Annual income is all amounts, monetary or not, that are received by any household member, and amounts anticipated to be received from sources outside the household during the 12 months following income certification. Calculating anticipated income has always been tricky, if you will, because HUD does not provide definitions for the terms periodic and sporadic. Both periodic and sporadic are crucial for determining if a specific source of funds is counted as income or not. As a refresher, DCA GHFA defines periodic as occurring or appearing at regular intervals, often in the same or similar amounts. Sporadic is defined by DCA GHFA as occurring occasionally, irregularly, and on no predetermined schedule. For these definitions and an update to this policy, please refer to Chapter 5 beginning on page 115. Before, when calculating anticipated income, periodic versus sporadic income was discretionary, and determining what was periodic versus sporadic required subjectivity. Now, annual income still includes the anticipated income category and requires subjectivity in determining what is periodic and what is sporadic income. However, now they are not competing. You consider both when calculating anticipated income. What's changed is the HOTMA update has added a new subcategory called non-recurring. Non-recurring income is income that will end in 12 months following a recertification date and will not be repeated. Under assets and income, so far we've covered the $50,000 cash assets threshold increase, as well as changes to anticipated income from periodic versus sporadic to now include non-recurring. And now we're going to take a look at student assistance. I encourage you to make some notes here or maybe grab the compliance manual and follow along. With the HOTMA update of 2024, there's a new way to calculate student assistance income. When referencing this policy in the past, it would be found in our compliance manual under Unearned Income Overview Student Financial Assistance. Now, you will reference this policy under Student Financial Assistance for Section 8 recipients and Student Financial Assistance for non-Section 8 recipients, respectively. This policy change is in Chapter 5 from pages 140 to 146. To recall, the policy before HOTMA, to put it simply, stated if a household was not receiving Section 8 assistance, any scholarship or grants were excluded as income. And if a household was receiving Section 8, student assistance was counted as income. However, HOTMA introduces a new way to calculate income, and it is expected that all households will apply the HOTMA student assistance rules, that is, if and or when the involved appropriation language is removed from the HUD funding bills. What appropriation language, you ask? As a reminder, the current appropriation language from HUD states for Section 8 programs, while certain appropriation language is in place, any financial assistance in excess amounts received for tuition that an individual receives under the Higher Education Act of 1965, or HEA for short, from private sources or from an institution of higher education, shall be considered income to that individual. The primary difference between the Section 8 and HOTMA student assistance approaches are how the HEA and money from private sources are counted. Under HOTMA, HEA is not counted as income, and money from private sources is gift income, not student assistance. Now, generally for LIHTC and home households, student financial assistance is counted per the HOTMA student assistance rules. However, there is an exception for LIHTC households with or without home that received Section 8 rental assistance while the HUD Appropriations Act's language is in place. If the household is in a LIHTC unit with or without home and is receiving Section 8 rental assistance through a Section 8 Housing Choice Voucher or project-based Section 8, income is counted differently. This makes it an important compliance matter to ask a household in a LIHTC unit if they are receiving or anticipate receiving Section 8 assistance. For Section 8 recipients, student assistance received by any student, full or part-time, who attends an institution of higher learning must be counted, except students who are over the age of 23 and have a dependent child, and students who are dependents of the household. There are flowcharts in the updated DCA LIHTC and Home Compliance Manual that help you to determine how and when to consider student income for households receiving Section 8 and for those that are not. If there is a student at an institution of higher education, full-time or part-time, that is receiving student financial assistance from the Higher Education Act in excess of the total covered educational cost, then you must follow the calculation of subtracting remaining student expenses from non-HGA student assistance, if any. Any remaining non-HEA student assistance is then counted as income. Please refer back to page 145 in our compliance manual for this calculation, as well as page 146 for sample calculations. Our last change regarding income and assets pertains to specific asset types. Formerly, personal property was only counted as an asset if it was being held as an investment. This included gems, jewelry, coin collections, or antique cars held as an investment. Personal jewelry was not considered an asset. Therefore, when it comes to qualified household determinations, there were 11 specific asset types, which fell under real and personal property. Now, there are 3 asset categories: real property, non-necessary personal property, and necessary personal property, and 12 specific asset types. The details of the specific asset types and how they are treated can be found in Chapter 6 and begins on page 149. Okay, so the addition of necessary and non-necessary personal property requires us to understand the difference. Non-necessary personal property is counted as an asset when the total is over $50,000. There goes that $50,000 again. The income is counted as well. If the total is $50,000 or less, you exclude the values from the assets, but the income is counted. Got it? All right, let's move on. If you were following along in your DCA LIHTC and Home Compliance Manual, you will see that the changes occurred between chapters 1 through 7. So there were no changes for chapters 7 through 12. This includes, but not limited to, the rules for acquisition, rehab, and syndication, corrections and consequences of noncompliance, management company change approval process, and recertifications. One last thing. If you go back to the very beginning of the compliance manual, on pages 8 through 10, you will find a full list of updates that were a result of either your feedback or items we discovered needed clarification, as well as corrections due to clerical errors discovered in the previous version. And that's it. We got through another training. That was the DCA LIHTC and Home Compliance Manual changes and or revisions from the 2023 Compliance Manual to the 2024 Compliance Manual. Keep in mind that we are currently adhering to the 2024 DCA LIHTC and Home Compliance Manual. My name is Tarika Dorner. I'm the OPM trainer. I can be reached at this email and or cell phone number. I look forward to hearing from you, and I look forward to training you again. Thanks so much.